We're taught that national crises destroy economies, that recessions drain wealth, that governments fear instability because it threatens the system. But what if that's only half the story? What if the very crises we fear, currency collapses, market crashes, inflation spikes, sovereign defaults, are part of a silent, recurring monetary loop that doesn't just survive chaos, it profits from it? Because behind every headline shouting emergency, behind every urgent press conference, behind every bailout, rescue plan, stimulus package, or monetary intervention, there's a quiet mechanism that converts national crises into revenue for the institutions that operate above the chaos. This is not the conspiracy theory you've heard. This is the mechanical truth very few are allowed to understand. And once you see the loop, you won't be able to unsee it. Today you're going to learn why crises always lead to more lending, why financial markets rally after disasters, how central banks use panic to expand control, how sovereign debt becomes more profitable during instability, and why governments never break the cycle, because the cycle finances them. This is the covert monetary loop that converts national crises into revenue. Every crisis seems to begin the same way. A bank collapses, a bubble bursts, a nation defaults, markets panic. But before we trace that loop, we need to understand the world that allows it. Because the financial system we live under didn't evolve naturally. It was designed gradually, deliberately, and with a purpose. The key players in the loop. To understand the loop, you must know its operators: central banks, primary dealer banks, sovereign bond markets, the IMF and global lenders, hedge funds and institutional investors. These entities don't sit around plotting chaos. They simply operate inside a system where instability creates financial opportunities that the structure rewards. And it all began with a turning point in modern history. To find the loop's origin, we go back to a moment that reshaped global finance, 1971, the end of the gold standard. When President Nixon decoupled the dollar from gold, he didn't just end an era, he opened the door to unlimited, unconstrained money creation. From that moment forward, money became debt, debt became policy, policy became markets, and markets became the economy. Governments no longer needed gold to back their currencies. They needed debt, sovereign debt, bought by banks, funds, and foreign governments. This made crises useful. Why? Because every crisis justifies more borrowing, more central bank intervention, more money creation, and more dependency on the institutions that supply liquidity. A crisis became a reason to expand the system's reach. This wasn't a secret plan. It was a structural evolution. But the loop still needed one more ingredient before it fully formed. By the 1980s and 1990s, global finance had transformed. Markets were deregulated. Banks grew larger through mergers. Derivatives exploded. Global capital moved at light speed. This was the period when the monetary loop became self-reinforcing. Here's how the loop works. 1. Crisis strikes, recession, inflation, defaults, bank failures. 2. Fear spikes, markets sell off, currencies tumble. 3. Central banks intervene, lowering rates, printing money, guaranteeing liquidity. 4. Governments issue. In this loop, every crisis expands. Central bank balance sheets, government debt, supply market, dependence on intervention, investor profits from volatility, banking sector influence and global financial integration. Crises don't weaken the system, they feed it. And the biggest players learn to expect and sometimes rely on periodic instability. It was the moment when billions of people finally saw the loop in real time. Phase 1, collapse. Lehman Brothers fell. Banks froze, credit halted, markets plunged. Phase 2, central bank rescue. The Federal Reserve injected liquidity, cut rates to zero, and bailed out key institutions. Phase 3, record borrowing. Governments issued massive amounts of new debt to stimulate the economy. Phase 4, profit extraction. Primary dealer banks, the same institutions that helped cause the crisis, earned fees for underwriting the new debt, then traded it for profit. Phase 5, market rally. Stocks rebounded far beyond pre-crisis levels. Wealth inequality surged as assets owned by the top 10% skyrocketed. Phase 6, the loop resets. Debt remained. Regulations were temporary. Systemic risk persisted. The crisis became revenue for the system, and the public paid the bill. But 2008 wasn't the peak of the loop. Another shock was coming that would take the loop to extremes no one imagined. When the world shut down in 2020, it triggered the largest monetary intervention in history. Trillions in liquidity, near zero interest rates worldwide, unprecedented government borrowing, sovereign debt exploding in every country simultaneously. But here's what most people never noticed. 1. Debt issuance reached historic highs. Banks profited primary. Dealers earned billions underwriting government bonds, needed to save the economy. 2. Central banks became the biggest buyers of debt. The Federal Reserve, ECB, and Bank of Japan absorbed government debt at record speed. 3. Asset markets soared. Despite crisis stocks, bonds, housing, crypto, everything surged because the loop flooded the system with money. 4. Inflation hit 40-year highs, yet governments borrowed even more high. Inflation should reduce debt issuance. Instead, it led to more stimulus, assistance, and emergency spending. Crisis became normalized as a financial input, and the loop tightened around every nation. Politicians promise solutions: reduce debt, cut inflation, balance the budget, regulate the banks. None of this ever succeeds, because breaking the loop would collapse the system built on top of it. Let's look at why fixes always fail. 1. Reducing debt shrinks the money supply. This causes recession. 2. Raising interest rates to fight inflation makes debt more expensive. Governments pay more, gives borrow more, gives loop deepens. 3. Cutting spending triggers political backlash. Social programs shrink, gives unemployment rises, gives stimulus comes back, gives more debt. 4. Regulating banks pushes financial activity into the shadows. Shadow banking grows, gives crises become more severe, gives more bailouts. Every solution contains its opposite. Because the loop has become structural, it doesn't operate outside crises. It operates through crises. Today you can see the loop everywhere once you know where to look. The United States national debt over $34 trillion, interest payments larger than military spending, every recession followed by massive liquidity injections. Europe, energy crisis gives ECB buys more bonds. Italy, France, UK, reliant on market confidence, austerity cycles, followed by borrowing cycles. China, property market collapse, gives stimulus, gives more local government debt. Shadow finance, expanding state banks, absorbing losses, developing nations, dozens trapped in IMF loan cycles, higher US rates force more borrowing. Crisis gives loan, gives austerity, gives slowdown, gives crisis. Wherever you look, the loop behaves the same. Crisis gives intervention, gives debt growth, gives market rally, gives dependency, gives reset. The loop is universal because the system behind it is universal. 3 core takeaways. Takeaway number 1. Crises are not interruptions, they are inputs. The modern financial system grows through emergency lending, liquidity injections, and volatility. Stability is not profitable. Instability is. Takeaway number 2. The monetary loop turns public pain into private gains. When nations suffer, the institutions that control debt, liquidity, and capital markets experience some of their biggest windfalls. Takeaway number 3. The loop can't be broken from inside the system. Every attempted fix, regulation, austerity, stimulus, expands the loop instead of ending it. There is a limit. The loop requires more debt, more intervention, more liquidity, more crises. But debt now grows faster than global GDP. Interventions are bigger each decade. Crises happen more frequently. Eventually, a system that relies on crises must face a crisis it can't